Thank you all for coming. It's always nerve-wracking seeing who's going to show up for a session like this. Our session today is about technology and payment trends and the impact specifically on rental property. My goal today is just kind of walk through the technology, the changes, the payments, the evolution of payments. I'm going to kind of talk about a broad brush impacting all industries, and then close specifically with the rental property management and real estate. We do have a cozy group here today, so if you have any questions, please jump in. I do want to keep it conversational. And I allotted about an hour or so. I think the slides put me to about an hour, so we will have half an hour open discussion at the end. Just a little bit about myself. My name is Mislav Majic. I'm the president of PayProp Canada. I spent my whole career in financial technology and payments. I had a good fortune of starting up a couple of businesses and working with teams to build financial and payment businesses, starting with what feels like many years ago with my brother in our basement. We built an enterprise accounts payable automation company. Back then it was automating check production, so it was very, very evolutionary at the time, and then became a full cash management application solution for enterprise companies. Recently at a publicly traded company called VersaPay, we merged payments and financial technology to become leaders in accounts receivables, so merging FinTech payments, again, for every vertical, including commercial real estate, trucking, manufacturing. And now at PayProp, I was really excited when this opportunity came in because they're quite fundamentally different in the way they process payments. It's a great company because 15 years of innovation, not just in financial technology, but in everything, globally building realtor.coms, MLS sites, and so on. So very, very excited about that. I will also do my absolute best not to continue talking about PayProp, and it's really about technology and payments and impact really on business period. So the agenda for today is really talking about technology, specifically financial technology, definition, landscape, and then the impact on all businesses. Financial technology is very, very closely related to payments. Those are the two bookends of a process, financial technology and payments. So we'll bleed into a discussion around payments, disruptions, and what's going on in marketplaces, and then that naturally leads us on to the impact on the residential real estate markets. We'll talk about opportunities. Anytime that there is fundamental changes in the way we do business, there's obviously threats, but there's incredible opportunities. So what is FinTech? You guys probably heard about the term. I just read this morning that in the last quarter there was over $5 billion invested in 251 companies just in 3-month periods, over $5 billion. So even if it's not great technology, it's going to impact our world because there's a lot of investment going on. The challenge with FinTech is it's really, really hard to figure out exactly what it is. It's impacting our day-to-day lives, but there's no real definition. Investopedia notes that the industry is mere 5 years old, so we don't 100% know exactly what it is. It's less than 5 years old, and it's impacting our day-to-day lives. The best way to describe, at least from my perspective, what financial technology is using that technology to disrupt value chain, meaning how we interact internally within our companies, how do we handle our clients, even supplier. That whole ecosystem gets disrupted and changed for better. Is this changing? So how does that, what's the impact, how is it changing business? First and foremost, it's accessibility. So financial technology initially starts by coming into your organization, making data more accessible, making staff more efficient, but it immediately then impacts the whole ecosystem. So when you think about your customers, being able to get data to your customers, invoices to your customers quicker, collaborate in real time with customers rather than leaving voicemails. On the accounts payable side, it's bringing that supplier world in, controlling your spends, and having visibility on both sides. Are you getting paid, and what you're paying for? Are you taking discounts? So accessibility is incredible. Then that also allows speed. If we look at that time is money, speed is critical. And the only way we can achieve speed if we create accessibility. Those two bullet points are really, really important, but without reducing friction, they're kind of meaningless. So that's kind of financial technology, or any technology, is supposed to wrap all these 3 points. Make it really a great experience, make it accessible, easy to use, remove friction, and that's going to impact your business. To the point, I recently read this quote, and for me it was mind-blowing, so I wanted to use it here. Are you guys familiar with Alibaba? Just want to make sure everybody knows. It's a huge retailer out of China. There was a lot of speculation that they will break the $20 billion barrier in one day of commerce, and this November they have a Singles Day in China. Last year they did about 17 billion. This year they broke the record for a single largest day in commerce. Over $25 billion was processed. So if we look at even 5 years ago, that would probably crash any websites, and to process that many payments would be impossible because they didn't sell 25 items for $1 billion each. Today they sold $25 billion. I don't know how many transactions that is, but that's a lot. So all to do with accessibility, ease of use, eliminating friction, and speed. Speed of processing, speed of handling customers. So there's also a notion that we look at technology and saying how much time it's saving. And it does. It saves a lot of time. But there's a much bigger opportunity because no other retailer in the world could have sold $25 billion in one day with no matter how many employees you had. So there's an incredible opportunity to grow your business by deploying new technologies. I think I already defined how this technology is changing the world, but interesting stat there. In 1955, Fortune magazine first put out its list of 500. So these were the biggest, the best, most well-run managed companies. They were technologically advanced, and 60 years later, only 71 of those giants that we all admired and studied in our university business courses are no longer on that list. One thing that probably you notice that 1955, 60 years later, that puts us to 2015. There is a reason for that, and I'll show you another stat very quickly. But how is technology impacting that? Hopefully I'm not dating myself, but Blockbuster. I remember in industry, when growing up as a kid, you go to your local video store, it was very, very fragmented. There was almost no video stores that were kind of a chain. It was always owned by a local retailer. It was fragmented, millions of different video chains. Blockbuster came in, gave you a breadth of different options, free popcorn. They were just a darling of, I think, the 90s, and today they're no longer around. Borders, similar idea, came into a space that was very fragmented, created a great experience for clients, and almost as quickly as they became industry standards, they're also no longer around. Canvas is an interesting one because we see a lot of impact on media. Media companies that are getting into different facets of media, not just online advertising or online media, but buying the Blue Jays, buying the content itself, are thriving, and the ones that kind of stuck with their bread and butter are no longer around. When I was putting this together, I was reading up on Canvas, and Financial Post just before the sale to Shaw said if you owned any of the Canvas stock, it was worthless. And the company was worth at $1.6 billion. So the change is rapid and quick. For me, this is the interesting one, Kodak, because in 1977, they invented what killed them in the 2000s. In 1977, Kodak developed their first digital camera. So they actually are credited with inventing the digital camera. They just never took advantage of the technology, and by the time they did, it was already too late. And another interesting one, Nokia. There's a couple of more points about Nokia, but if you remember not long ago, maybe 10 years ago, it was the undisputed king. I could not wait for that little Nokia phone to come out. I mean, they owned the marketplace. So today, that lifespan that used to be about 60 years of being listed on the Fortune 500 has gone down to 15 years. And probably if we chat in the next couple of years, that 15 years will start becoming 5 years or something. The change and evolution is so rapid that things that we remember just a few years ago being an undisputed leader is irrelevant today. And I promised I was going to talk about Nokia. So as I was putting this presentation together, on the date that I was putting this presentation, I came across this magazine cover where, I don't know if you can see it, November 12th, 2007. So 10 years ago, we were all in awe of what this technology giant and one of the biggest innovators in the world was doing. 1 billion customers at a time, and I would suspect that was 50-60% worldwide market capture. Who can challenge Nokia? So I'm using that as a segue into the next section. Disrupting the disruptor. So who challenged Nokia? It was BlackBerry. So when we look at a time span of 10 years, where the undisputed leader in a marketplace that had, well, almost you can consider it the whole marketplace at the time, was displaced and made irrelevant by a company that today no longer makes the devices that displaced a giant from just short 10 years ago. So the evolution in technology is evolving so rapidly that even the disruptors, or who we see or believe are the disruptors, are no longer relevant. And in BlackBerry's case, don't even do what they displaced the giants a few years ago. MySpace had the runway, had the market share, everybody was using it, everybody got behind it, and almost as quickly as it became relevant, it became irrelevant. Yahoo, at one point, not too long ago, it was buying the biggest brands in the world, and today it's sold for a fraction of what it was worth a few years ago. PayPal. So I might be going out on a limb here because I do believe PayPal is very, very relevant. But if you think a few years ago how important PayPal was, because there was not a lot of trust on the internet, and if you were to buy anything, what made you feel so comfortable and secure is putting your credit card in a PayPal account and buying that product online or eBay or anything like that. For the last number of years, they've been trying to penetrate different markets, business segments, and so on. And I do believe they had some success in it. But when I think of companies like Square, Stripe, that basically are capturing that market at a rapid pace, you kind of start feeling that they're falling behind, at least in a customer perception mind. For me, the most interesting thing about PayPal and how the Stripes and Squares of the world are displacing this brand is not about price, because PayPal is quite expensive. That's why it appeals to consumers and small businesses. So you would think whoever comes in and displaces PayPal is just going to cut costs. But Stripes and Squares, for most part, are equally priced, if not more expensive. They're winning because of better user experience. So it's just a really, really interesting notion that we always think it's price, but it's actually trust and user experience. And then payments. How many of you carry cash these days? Again, a few years ago, I needed $20 in my wallet just in case something went wrong. And today, I just feel better using my credit card because it's all detailed out. I know my expenses, it's easy, and I feel more secure with it. I was at a recent conference. Our lawyers are Gowlings. They hosted a cryptocurrency conference, and I was just blown away by the adoption, by the comfort with cryptocurrencies. They're not a mainstream today, but they're definitely moving towards becoming mainstream. So once they gain that trust levels, the user experience of using cryptocurrency is unmatched. What this slide is really showing is how that 67 years is now becoming almost a yearly occurrence, and probably quickly maybe even a quarterly occurrence. So that brings us to financial technology and payments, because they're basically two sides of a coin. They're always married together. When you think of Alibaba, you're thinking about processing the payments, but those are transactions. Those are also financial transactions. So FinTech and payments are always married. And when you look at the key is about frictionless. I remember when Apple Pay was coming out, I know there was such a big demand for Apple Pay before it was even available. Before even a retailer could actually accept Apple Pay, consumers were demanding it. I could not wait to download the app, put their credit card in. So it's all about that user experience and enablement. And again, it's not about the price. You can grow your business, you can offer a better experience, you make it easy to interact. It's not about reducing cost, it's about a better experience. And that's what we see over and over and over again. It always boils down to taking away friction, gaining trust, and creating a better experience. So we look at that and say, where's the opportunity? I think hopefully it's slowly starting to percolate where the opportunity is, but Leonard Brody has this great, The Great Rewrite. It's an amazing read if you guys have some time. Just an excellent writer. Couple of excerpts over the next 2 slides I'm using is that over the next 24 months, 1 billion people will come online. Just do a dramatic pause here, because for me, when I saw that, that was just an incredible stat. We feel that everything is already electronified, and if you don't have a website, you don't exist, even though it costs $20, $30 to pop a website. And there's going to be 1 billion people coming online in the next 24 months. As he quotes here, it's the single largest event in history. So when you think about any sort of massive fundamental change in the economy, in how businesses operate, all of a sudden the downfall of a big organization and new companies coming up and becoming the Fortune 500 darlings, it's always associated to something that fundamentally changes. And bringing 1 billion people online within the next 2 years, as he puts it, is the single largest event in history. It's a perfect storm. There's going to be incredible amount of opportunities for the people that jump on that opportunity and see it for what it is. The other interesting thing for me is bifurcation of human beings and payments. This was an interesting stat as well. We have one physical and one virtual self. We spend 65% of our time in our virtual self. So I know my kids probably spend a lot more than 65% of that time, but kind of start thinking, is that correct? And this morning I'm on a GO train coming here, and there's dozens and hundreds of people, and we're all either on a laptop or on a phone, because it's a 20-minute, half an hour drive. We're either checking out something to buy. I mean, it was Cyber Monday and Black Friday, so we were all online, or you're doing work. I mean, just because you're doing it online, that means it's a cloud-based application that you're working on. So if you actually pay attention how much time you spend online, this is probably even a conservative statistic, 65% of the time. The biggest thing is, the biggest difference is the trust. And a few years ago, when you're on the internet talking about that PayPal story, it was PayPal's biggest value was the trust. I knew PayPal was going to hold my card securely. Yes, I had to sign up, and the other person had to have an account, so it wasn't the greatest experience, but the trust was what they were selling. Today, we trust internet more than we trust bricks and mortars. I mean, as I said, if you do not have $100 website, I don't care if you have a billion-dollar manufacturing facility, you do not exist. So we trust the internet, we trust what we see, and we're spending a lot more time online. I would suspect that Black Friday and Cyber Monday, people were spending a lot more than 65% of their day online. So Mislav, all of that is neat. What's the importance for the rental market? Little story before I jump in on the statistics. We have an international employee that came over to Canada for next 12 to 18 months, and we had to find a place for her to stay. So for the first few weeks, we went Airbnb. It was an amazing experience. It was fun. We looked at different places, different cool places. Is it downtown? Is it suburbs? Wow, you can get 2-bedroom apartment. Oh, this one has a gym. This one has a pool. People would respond within almost less than 5 minutes. It was just brilliant. Once we decided which one, punch in a credit cards, drove to the place, we were moved in. Incredible experience. But after a couple of weeks, of course, we were looking for a full-time 12-month rental. And that was actually completely opposite. Just because we spend 65% of our time on the internet, we've looked at vacancies on different sites. And there's quite a bit of vacancies. The first challenge was 80% of those vacancies were not vacant. So as you kind of got excited about the possibilities and art of the possible, and this place is cool, and wouldn't it be really neat to live in this area of the city? It just kind of became worrisome because none of them are available. And everything was basically through telephone, voicemails, and so on. Again, it was just taking too much. And as our time was shrinking, it wasn't even about the experience. At this point, we were kind of worried because the Airbnb time was running out and we were sort of desperate to find a place. When we found the place, going through the applications, I think it took about half an hour to 35 minutes to fill in all the application via paper. These ones had to be faxed in. I haven't seen that in a long time, but they were faxed in, and then we had to generate a certified check, which for an international employee coming into Canada is kind of a non-starter because you won't have a checkbook for at least another month. So it was just a heartburn after heartburn. We worked through it because we were desperate to find a place. Needless to say, it wasn't the best experience. So the biggest stat, I looked at that and said, yes, I mean, there's so many ways to create a great experience. There's so many ways to create a much more efficient accessibility, speed, reduce friction, what we talked about. But one stat that really stood out to me, IBIS report said, 70% of all rental payments still today in Canada are made by a check. So, okay, when we talk to property managers every day, that's the notion we get. Our tenants are comfortable, they want to pay with checks. We do kind of ask, do you offer any other services? No, or it's pre-authorized debit. And pre-authorized debit has been around for decades. There's always that trust issue. I'm giving you my bank account, you can hit the bank account anytime you feel. If I leave the residential, your apartment, you're still going to keep hitting my bank account. There's a lot of trust issues related to that. That same survey shows that 78% of all tenants would love to pay electronically. So that's really our bias. That's our comfort level. We're looking at it and going, well, tenants are happy to pay with checks. You know, if it's not broken, don't fix it. And then you look at a survey and say most, if not all, of your clients actually do not want to pay with a form of payment that you are offering today. So what's the driving force behind these movements? It's the adoption of smartphone devices. Yes, it's trust. Yes, it's making it easy. But now we have accessibilities. I mean, my kids have cell phones because they go on TTC, which I don't think I would have ever done 5 years ago, but it's now so accessible. My mother-in-law, who's in her late 70s, now exclusively does everything off her iPad because it's easy. And I think within less than 2 years ago, she was still going to the bank. She was one of those people loving to chat to the teller. It was trust, it was comfort, it was easier. Off the desktop, she didn't quite understand it. She would call me or my brother-in-law to be the tech support, to walk her through it. Off an iPad, she is FaceTiming, texting, paying all her bills. She's the mobile grandma now. So it's trust, it's ease of use, it's the adoption that drives behavior. So I think I kind of spelled these out, but it is all about trust. We're comfortable with it. We know everybody's doing it. It's easy to use. We trust it, and most importantly, it's very, very, very convenient. So, March of technological progress and disruption. I just really like that line, so I used it. Really, the punchline is few industries have been immune to it. In my previous work, as I said, we married the financial technology with payments, and we were successful in every vertical. So trucking and logistics, media, manufacturing, technology, commercial real estate. Marrying financial technology and payments was impactful for every industry, which was amazing. The biggest disruption, as we see, obviously media and retail, the two stories that we talked about, Alibaba and obviously the Canvas communications. But transportation is also significantly disrupted. But that doesn't mean that there isn't opportunity within these verticals. I look at Canada Post. A few years ago, there was a lot of talk, what do we do with Canada Post at the government level? Nobody's using mail. Nobody's even sending Christmas cards anymore. So the volume of mail was going down significantly. And today, with such adoption of e-commerce, I think Canada Post does more business sending parcels to your homes than they ever did before. So within their vertical, one door kind of closed because there's still mail going on, but a whole new vertical and opportunity opened up. Using the same technology, same warehouses, they're now just shipping packages versus sending postcards and pieces of mail. The one that hasn't been up until now disrupted as much is banking. So I do believe that's sort of a connection between rental market space and banks not being overly disrupted. Why the status quo was what we see today, 70% of payments still being made by check. Interesting stats is why not banking? Well, obviously regulatory barriers. It's not an industry that can flip a switch and change overnight. The other thing is control over the payment system. Obviously, the banking network controls all the payments, and no matter how we pay, it still goes through the banking network. And who do you trust more than going to your bank and depositing your money, getting your mortgage? And there's a high level of trust. Even at an enterprise level, dealing with CFOs my whole life, the two sources of information they would always go is to their ERP supplier, because they spend millions of dollars into their ERP. So any consultants, any partners, that was the network. And the second place would be their bank, because that's their back-end processing. So those were the two biggest resources. I would think Google has now creeped up to maybe number one, or at least in the top three, but it is that comfort and trust. And I know we have some folks from the bank here too. So hopefully you guys can agree that there is that sea of change. Depositor, borrowers, investors, and businesses and consumers really, that's the bank's customers. And they are looking for alternatives. They're looking for better ways to do business, get access to cash. And it's not necessarily just about the rate. It's about accessibility. It's about convenience, speed of access. And millennials, so folks, new consumers, new folks coming to the market, obviously are impacting how we do business. I debated, do I put millennials, because they might really, really be too young. In our office, we have a fairly young team. I say young, 20s and 30s, so not millennials, but nobody has a checkbook. So I don't necessarily think it's just millennials. it's all folks are moving away and demanding more flexible financial products. If any of you have recently signed up for a mortgage or you looked at an insurance quote, I'm almost certain you didn't walk into a bank, sat down with the mortgage broker and had a long chat. You probably looked it up online first, see which banks have great rates, and then send an email or submitted an application, whittle your list down to a handful that you actually wanted to meet. Same with insurance. I mean, time, accessibility, great experience. So the top reasons, it is about rates. It's about educating yourself about the best product for what you're looking for. But I think ease of access, we're busy today. And as much as technology is giving us all this free time, it seems like we're busier and busier and busier than we were ever before. So that should mean that there's impact on the growth of your business and growth of opportunities that you're doing, because you're surely not watching more TV because the technology is running in the background. And again, it's all about the experience, it's all about simplicity. It always boils down to accessibility, speed, and removing of friction. So when we look at the impact of disruption, customers have grown accustomed to cutting the traditional middleman. So in many senses, this could be a scary statement, because a lot of what we do is, in many cases, being a middleman. But when we look at services like Uber, Airbnb, Kickstarter, they've all disrupted their sector. In some cases, there was a big threat for the incumbent leaders in that space. But when you look at every one of these that I just mentioned, whoever jumped on the bandwagon, they actually increased the revenues of the service providers. So with Uber, yes, there was a huge issue with taxi industry. But today you hear more about taxi drivers sort of cutting out the middleman and actually being Uber drivers, because better experience, better hours. Airbnb, yes, it's cutting out into certain segments even of residential property managers, but we're already speaking to property managers who are leveraging this. So when they have landlords with properties, especially in downtown Toronto where there is a lot of demand for properties, and if you can charge X amount on a 12-month lease, if you use Airbnb, you can multiply that X amount by 2 or 3 times with the shorter term rentals. So if you have technology and you're able to do a much quicker turnover, charge a premium, you're looking amazing for your landlords, because you're really adding a lot more revenue. And since there's a management fee that's typically variable, you're actually increasing your revenues as well. So these services can be looked at as very scary and cutting into profits, almost eliminating the players within the space. Or for creative folks, they can become really a whole new opportunity to leverage the services and multiply the revenue streams and margins. So it's just how you look at them. Why lots of folks, not just us, look at the rental market and think it's absolutely ready for disruption? Well, first one is obviously banking is undergoing a disruption. So check is no longer the only form of payment that tenants want to pay with, and it's not the only way that you can collect rents. All the banks have great services that enable electronified experience, and there's companies at this show, including us, that obviously want to enable a better experience. So there's many different ways to enable an amazing tenant experience, to pay much quicker. The market itself is very large. So looking at that IBIS study, it's estimated about $6.2 billion. So it's not a small market. And this is Canada only. I'm not looking at North American wide. What's really exciting about it is the fact that it's a service-based industry and the margins are very high in property management space. Like the video stores of the past, it is highly fragmented. There are a handful, I think less than 10 players in the market space, that own more than 1%. I think they add up to something about 10%, but the study shows that the rest of the markets, nobody else owns more than 1% of that market space. So it's very highly fragmented. And the barriers to entry are low. It's a service-based business. In Canada, I said the PayProp is an international company. In our other markets, South Africa, for example, highly regulated. You cannot be a property manager unless you're a licensed real estate agent certified to do property rentals. So highly regulated. It has to be processed through a trust environment, trust accounts. There's rules and regulations of what you have to do and who can actually do this. When you look at Canada, there's really no regulations to becoming a property manager. There's no regulations about how you should be handling money. There's guidelines. There's no actual regulation saying that you need a clearing account, you need a trust environment. It's highly unregulated. When we have our board meetings, it's kind of funny because the South African contingents always laugh. Say, we're a third world country, we don't have any checks. And you process most of your rental payments with something that we did away 30 years ago. So it's a bit of a chuckle. So barriers to entry are very low. We see a lot of new property managers coming into space. And what's really interesting about this space, at least for me, it's the utilization of technology is very low. We're always relying on the skills of the people, and the property managers, especially ones that have been in the business for a very long time, I mean, they can tell you how many apartments they have, which one is vacant. It's all in their head. They know how much rent, how much dollars per square foot they earn. They have everything in their head, and they can rifle it off very easily, which is amazing. It's impossible to scale, probably why it's fragmented, but it's amazing. And these are sort of the typical things you see in any vertical: low adoption of technology, high margins, a very big market, very fragmented, that makes it exposed to potential change or disruptions. So there's two ways to look at that disruption. I always like to look at it as opportunity knocks, because any change, there's always a significant opportunity to capture more market share. So the question is always, do you seize that opportunity? Do you become more agile? Do you embrace change? See the market shifts, get on the front of that train and capture more market space? Or do you just do the same old, same old? Looking at it from this lens, property managers service two clients: their tenants and their landlords. Tenants are consumers. They want an easy experience. They want to pay their rent off of mobile phones. They don't want voicemails, emails. They want text messages. They would just make it easy and make it a great experience. Your landlords, partially consumers, but they're also business folks. So they want accessibility, speed. They want to know how much money are they making, what's the vacancies in their buildings, and they want that not once a month. They would love that off of an app so they can check at any point. So you're looking at the two forces that are impacting this market: the payments as well as financial technology. Ease, accessibility, remove friction. And I did this one on purpose. I'm not trying to fill in the time. But to me, this is the stat that kind of says, at some point, which probably is very soon, there's going to be a wholesale changes in the space. If your clients are demanding something that you're not offering, and I'm always surprised speaking to property managers, some are doing everything and anything to enable it. Others are saying, no, my tenants absolutely want to pay with the cash. But there is a huge discrepancy what your client wants and the services you're offering. And then the impact of the change. So we kind of looked at it and said, the three markets that we operate in is obviously Canada, UK. UK is our head office in London, and then South Africa. And we looked at the stats, so the growth of this residential real estate market. In Canada, 2016 was 2.3%, UK 1.2%. I did my best to try to find another stat, but PayProp in South Africa is the absolute dominant player. So if you Google anything to do with residential rental market space, I had to actually use our stat because every publication, every magazine uses our rental reports statistics, and there's a growth about 7.6%. So reasonable growth. I mean, it's a pretty commoditized business. It's been around for a long time. What we're seeing over and over again is our customers are growing by 23%. So the only way to grow in an industry that's growing by an average of 2 or 3% by 23% is to win business, win portfolios from landlords. That's the biggest things. And the way to do it is really through innovation. What are you offering those landlords more? How are you going to win that book of business from a landlord? We find that landlords don't necessarily put all their eggs in one basket, so they will deal with a number of different property managers, and the ones that offer better tenant experiences, more real-time interaction, visibility for the actual landlord, makes them feel comforted and trusted, all of a sudden starts getting more and more book of business. So that's really an interesting stat when you look at how technology is impacting the rental market. I mean, it's really, I think it's about a 10 times growth by deploying technologies versus doing the status quo. Another person that I love reading about is Peter Drucker. He's credited as the founder of modern management. Lots of great books. He was a management consultant. Love the line of don't tell me that you had a wonderful meeting, what you're going to do Monday. So act on things that are curious and interesting to you. And Peter Drucker process, and I think we naturally implement this in our day-to-day life. I know I do. Tell you what it is, and then I'll ask you if I'm correct. But he has a yesterday, today, Monday theory. So yesterday refers to our skills, our capabilities, our knowledge, talking about the property manager that knows every inch of every property, how much money that they're earning, what's vacant, and so on. It's incredible knowledge. Today talks about the urgencies. Obviously, the world is changing and the business is changing faster and faster. So you can see the opportunities, you can see the challenges, and then Monday, what do you do about it? Do you move quickly? Do you figure out what you want to do, how you want to take advantage of it? And do you want to act on it on Monday, or just have a good meeting, kind of put it away, and act on it when you absolutely must? I look at this in my day-to-day life, and every diet I wanted to start, or I was going to buy a gym membership, always starts on Monday. Haven't really acted yet, but it's going to be one day Monday. So it's all about, if you see trends, if you see the impacts, the quicker you can act on it. Don't just look at it as this is a really, really neat idea. The quicker you act on it, the quicker you're going to benefit from it. Which leads us to embracing change. I know change is scary. Change is scary for anybody. If you're a millennial or if you're doing something for 30 years. Last night at my son's hockey practice, I was talking to one of the fathers, and he has a printing business, a very, very successful printing business. But over coffee, we started talking about, and he's got big customers that don't do print anymore. He's got big customers, but his industry is no longer that relevant. So it's about embracing change. For him, it was talking about how do I get into social media, because the people that used to want printed brochures now are asking me for social media content and so on. I have design skills. I have obviously contacts. I have amazing customers. How do I transition that into another opportunity? I think that's the right way to look at it. So it's embracing change, because imagine doing something much faster, satisfying your customers, giving them more accessibility and speed. You can also do it a lot less expensively. People don't print because a piece of print costs $3-4. Online is free. So you can do something a lot cheaper, a lot faster, and create a much, much better experience. So your business is going to grow, but your business is also going to grow at a much higher margin rate. And at least for property managers, the three biggest constituents, if you will, are going to be thrilled because they're going to have an incredible experience. Your tenants, your landlords, and your staff. So embracing change obviously leads to huge opportunities. And I think this is one of the last slides. So seizing the opportunities, I just want to spend a few minutes about different companies that kind of intrigue me and how they seize the opportunity. So starting with Apple, I think it's the world's biggest brand today. I think it's a standard for excellence in design, in usability, user experience. Kind of forget that, I'd like to say maybe 10 years ago, the only reason Apple didn't close the doors because Microsoft needed a competitor and gave them $100 million. So here's a company that we all admire, and it's changing the way we interact. We even pay through Apple Pay, download music. I mean, they didn't invent the MP3 player. They didn't. They came into the market, and we all think of an iPod. Nobody refers to it as an MP3 player today. So they seized the opportunity, reshaped it, and they were almost bankrupt a few years ago. Or I guess they were bankrupt, and then Microsoft came in to help. Netflix. Two things. Obviously, Netflix is the reason we don't have Blockbuster stores anymore. But hopefully you guys remember that Netflix actually started out as a mail order video store. That was their creative way to enter the market. They felt that people maybe want to sit at home and instead of going to a Blockbuster store, wait a couple of days for a mail to arrive with their DVD and they could rent a video. I don't know how successful that was. I never used it. It didn't make sense to me. And then just is about to become irrelevant because through your TV boxes you could order Rogers online, or I'm sure Bell has a similar service. I'm just using Rogers. And Netflix almost became completely irrelevant. And then they changed the game. For $7.99 you could have access to unlimited movies and great content. Just an incredible story how they continuously saw change and became today a leader in a space. Somebody was telling me that they don't even download torrents, not that they're legal or anything like that, but because of Netflix, for $10 a month, I don't have to go through the process of doing this. I just click a button. I'm willing to pay money for something I was doing free yesterday because it's a great user experience. So it's not about cost cutting. It's about creating a great experience and actually increasing revenue, because things like Kodi and torrents and so on should have technically killed Netflix as well, and Netflix is actually thriving. Of course, I had to use Alibaba. 25 billion in one day is just unprecedented. Next one is Cisco. Cisco is doing quite well because they saw an opportunity. Nortel and Avaya obviously no longer are around, yet Cisco is thriving because they got into web conferencing and other systems. They saw where the business is going rather than routers and switches and handsets. They saw an opportunity. They didn't build it. They bought WebExes and other tools, but they saw it was going that way. They pivoted. So they didn't kill their legacy business. It's still a big revenue source, but they're slowly pivoting towards what we as businesses want to use for communications. In similar vein, Facebook obviously displaced MySpace, but today they're buying things like WhatsApp and different technologies because they see the market is changing so rapidly, and there's these great opportunities, there's utilizations that fall within the space that they're playing. So in their case, they're buying these companies and creating a much bigger system, and they're staying relevant in that way. And then the final one I wanted to use, I'm not sure that maybe for Luke it will make sense, but Naspers, they have roots within early days of PayProp as well. Naspers is an interesting company because if you Google them today, you will see that they're a global internet company. They own a lot of investments in that space. They brand themselves as leaders in online entertainment. A few years ago, Naspers was no different than Torstar. There were magazines and a newspaper organization that quickly realized that that legacy business has a very, very limited lifespan. And today they're worth about $143 billion. So they're a massive player in this space because they quickly pivoted from, not killed the business. Obviously, they still stayed within their legacy business. It was a revenue generator. I think probably still today they still have ownership within those legacy businesses, but they completely reinvested themselves as an online entertainment internet company and a bit of a hedge fund as well, because they invest in a lot of companies. Tencent is a huge investment that they were in early on, and I think a big chunk of their valuation is a handful of companies like that. So it doesn't mean that you're going to pivot or move away from becoming a property manager. What you have to be cognizant of is what's going on in the space. What do my clients want? What do my tenants want? How do I create a better experience? Why are these guys growing by 23% versus myself staying status quo? Am I worried about my legacy business or my legacy approach to business? What's the impact? How much runway do I have? Or do I jump, make changes within the same space, become creative, and really ride the wave? Because when there's this much change going on, there's going to be winners and losers. But I look at it as it's an incredible opportunity. So that's my theories that I wanted to share with you guys. So that took about 50 minutes or so. I want to open it up for any questions. Okay.